Ladies and gentlemen, we are now going to move on to our second presentation. This is again going to be live and virtually connected. We will take a couple of questions if you will have any for them. The topic is a very interesting one. It's about emerging correspondent banking considerations in money laundering, a very pertinent subject. And this is a presentation by a global financial crime expert. There's a slight change of plan, ladies and gentlemen. Our next presentation is themed at the emerging correspondent banking considerations in the sanctions screening. The presentation is by a global financial crime expert. Please welcome Mr. Sumit Sarkar, the Executive Director of the Head Financial Crime Compliance Correspondent Banking, Africa and Middle East with the Standard Chartered Bank.
Okay, I'm going to try and share my screen.
Let's welcome Mr. Sumit Sarkar, the Executive Director, Head Financial Crime Compliance, Correspondent Banking, Africa and Middle East with the Standard Chartered Bank.
Thank you, everyone. I'm going to try and just share my screen. Give me a minute to share my screen. Can you see my screen now? Okay.
Hello. Yes,
Well,
yes, please carry on.
Good evening, everyone. Thank you so much for inviting me to the summit. Quite a pleasure and an honor for me to be joining in today. And really the extinguished panel and the guests that we have, it's really nice to be part of this session. So today, I'm going to cover off correspondent banking, financial crime compliance risk. I do manage this on behalf of my bank, Standard Chartered Bank. So I try to share some of the best practices and some of the learnings that we have had, which should be fruitful for not only the audience, but for the larger audience as well. So some of the things I just wanted to start off with this slide, which I typically talk of as inherent tensions. So whilst we are in compliance and we try to manage and are responsible for financial crime risk management, but within compliance itself, we do see a lot of conflicting situations where you have got cost control at one end, and you also have cost of compliance, which tends to increase as the regulatory expectations and the situations and scenarios that we deal with keeps getting complicated. Similarly, on one hand, you see the challenge of de-risking by a lot of correspondent banks globally. Of late, this has been much more complicit. On the other hand, you also have a situation where you also need and the objective of financial inclusion. So whilst we support central government, central banks, financial inclusion agenda, there's also the risk of de-risking that we face in large continents, especially in some of the developing countries as well, and especially I think in markets where the inherent financial crime risk tends to be quite high. Similarly, we see the ask for payments and transparency in dealings, whilst on the other hand, you also have equally coming up data protection, confidentiality, and privacy expectations also moving up as well. So these are some of the challenges we face and some of the conflicting situations we face. We can go on to this slide, but I think I kind of try to highlight some of the things that we see in compliance, and especially in correspondent banking, where we have on one side the ask to support correspondent banking, support financial inclusion, support the agenda of developing economies and markets, but we also have the agenda of protecting the financial economy, also protecting the bank as a correspondent bank. Especially from where I come from, or where I manage US dollar, euro, to where we are the sixth largest bank providing such services, correspondent banking risk management becomes paranormally important for us to see that we provide services, but we provide the services in such a way that we can also manage the risks equally and identify the risks and mitigate them. So talking on the most pertinent topic, I wanted to really go through de-risking as an agenda slightly, because that's been a topic which has been quite a lot in prominence. So we all know the FATF defines de-risking in a particular way, where they talk about the phenomenon of FIs terminating or restricting the relationships. But what does it actually mean when we restrict relationships? Because that can take a variety of definitions and can take a variety of situations. My experience within banking over the last 10 to 14 years has been that we have primarily seen de-risking taking two forms. One form taking more of a wholesale exit and a wholesale de-risking, where banks, particularly large correspondent banks, just decide to exit a portfolio of relationships, or exit certain industries, or exit certain countries completely and say this is part of their agenda. A variety of reasons could be driving that decision. For example, it can be profitability. When you enter markets which have got inherent financial crime risks which tend to be higher, your enhanced due diligence costs, your financial crime compliance and regulatory compliance costs also shoot up. So that affects the profitability of organizations, and we tend to see the commercial aspects of decisions where, although fundamentally the risk can still be managed, but the cost tends to be too high. So it becomes a situation where risk versus reward situation, where the risk becomes sustainably or rather unsustainably higher, and the benefits don't tend to match up to those benefits which we want to reap as a commercial institution. So whilst we can go on and having an ideal compliance environment, whilst we can go on supporting, however, the cost becomes unsustainable. And that's when we see global banks taking the decision to de-risk and on a large scale, whole scale basis. In a recent survey that we did, we surveyed around 361 FI clients globally to understand what kind of situations they have faced, what's their reaction when they see and deal with correspondent banks. And not surprisingly, 63% of them have come back with the feedback that yes, they have actually experienced de-risking by their correspondent banks because of inherent risks and situations that we face. So this is one. The other way of dealing with de-risking situation, as we tend to do, and some of the other global banks also support us in doing that, is to look at de-risking from different lens altogether. The term that we use and the terminology that we use in this section is called de-risking through education, which is more of a partnership. So where we want to partner with the banks, the local regional banks, and support their compliance risk management framework, where it helps us, it helps the ecosystem to develop, where we support those banks to come up the value chain in improving their financial crime risk controls. It also helps us to remain relevant in those markets by participating and continuing to participate. Essentially, this works out in a way where we provide extensive training. We actually also provide web-based learning, specialist training to the staff of the local banks, who can then go back and utilize those knowledge in ramping up their financial crime risk management controls and framework, which then helps us to continue in those countries, in those geographies, in those products, and continue to bank with them. So it's more of a two-scale approach where we can de-risk wholesale, we can risk manage, and we can de-risk through education as well. A quick slide of what we see and how we look at geographies in different way. Where we as correspondent banks try to look at things more on a concentration of risk basis, where we want to see what's the concentration of risk in a particular geography that's going to expose us or elevate the risks. So typically we will look at Americas, Europe, Africa, Middle East, and there are some inherent risks which are very pertinent in those specific geographies. And we deal with them depending upon on a concentration risk basis. Obviously, the names that you see at the bottom, most of you are very, very familiar with as the consequences of non-compliance. The likes of Citi, Deutsche, Standard Chartered, Commerce Bank, HSBC, and recently JP Morgan have all faced the wrath of being non-compliant in one way or the other and had penalties imposed by the regulatory authorities. That's more of a financial impact perspective. Obviously, there are much larger things at play beyond just financial penalties. You also have got reputational risk and individual impacts as well. Of late, I don't know if you have been noticing, there have been quite a few situations where individuals are now being targeted by the authorities instead of just organizations themselves, which I think is a step in the right direction too. So in this audience, as I can see, there's a lot of respondent banks and BFIs. So I think I wanted to spare some time and see what's in it for you. How would you as a respondent bank and what we expect from you, and more importantly, what you can do better to improve your relationship with respondent banks and improve your controls in a way where correspondent banking becomes much more sustainable and much more feasible as well. So here are 3 very practical tips from our end, which any FI or NBFI can adopt and should be looking at enhancing them on a continuous basis. So the first topic that we talk about is engaging with correspondent banks, essentially meaning that you have a continuous dialogue or situation where you continuously deal with your correspondent banks and try to understand their practices, their expectations, their policies, their framework, and try and match up to them or be as close to them. That helps to build that trust and relationship with the correspondent banks. Enhancing your risk-based approach, essentially the bank's policies, framework, its strategy. Obviously, there is a risk-based approach in everything. The more the risk-based approach gets aligned to the correspondent banks, it becomes much easier to start trusting each other. It becomes much easier to make decisions, and also becomes risk management much easier as we tend to adopt and understand the risk practices and the definitions of risk-based approach being adopted by the respondent banks. So here it's more of translation of risk-based approach by the respondent bank and its interpretation by the correspondent bank being aligned. If we have situations where the risk-based approaches tend to be dramatically different, or the risk appetites tend to be dramatically different, that's where we see friction, that's where we see issues, that's where we typically see the wider decisions of de-risking and exit of relationships coming into picture. So this is quite an important one to understand and have an aligned risk-based approach between respondent and correspondents. The third important point is data analysis and reporting. This is a very critical factor, which is essential, and that we as correspondents treat this with utmost importance. Because what lies in data is something fascinating, and more improved data and more improved governance around data helps us and the respondent to analyze what their actual risks are, where their problems are, and how they're managing those issues and data points. So examples of data analysis and data reporting can be your data around suspicious activity, data around sanctions risk events, data around governance issues, regulatory matters. When this data really comes up on a consolidated basis, that's when risk management becomes much more holistic and becomes much more easier for us as a bank to look at risks more holistically. And that's why we always recommend that we share data to the extent possible, to the extent allowed by local legislations with the correspondent banks to facilitate better risk management. A lot of times we do see that data is there, but data is not being shared actively to help promote mutual interests. The last, I think, but a topic which is coming up a lot and something which is quite relevant to this audience is to collaborate with industry authorities and associations. Whilst we are part of many such forums and global organizations, I think at a local level, at a country level, at a regional level, there's a great opportunity for respondents to collaborate with their trade organizations, trade finance institutions and associations, and also with regulatory agencies, typically what we call as PPP or FISP, public-private partnership. This really promotes a situation where a sense of trust builds between the regulators, between the banks, between private institutions, and government institutions. So the more we see PPPs, the more we see collaboration, the more we see participation in such industry associations, I think it gives banks like us much more comfort It gives us a sense of assurance that yes, there is best sharing of best practices, there is active involvement of organizations towards one common objective. And that really helps our cause also to continue to support correspondent banking and to scale up business also. So 4 key tips for respondent banks: engage, enhance risk-based approach, improve data analysis and reporting, and collaborate with authorities and associations. I'm going to go through a few slides, pass them through, and then come up to this rather important slide that we talk about, is what we see and what we want to see is an ideal FCC program. So what does it make a program effective? What are the different components that one should be having in an ideal FCC program for it to be effective? Whilst on one hand we have the situation where we want to have all the data, where we need to have completeness, but it's also a matter of whether the program in itself, is it really effective or not? So it's like a tiff-off between your inherent risk and your residual risk. So what does an effective FCC program look like? What are the pillars that we want to see? So one of the fundamental things that we want to see is the ability for an FI or a respondent to understand its risk profile, to understand its own risk landscape. That essentially means how much of an understanding does the respondent have from its own inherent financial crime risk standpoint. In this screen, what you see are some of the top financial crime risks that we see right now, evolving horizon risks also, but quite pertinent. Some of them are quite new and evolving. You might not be seeing them on a global scale. You might be seeing them more on a restricted basis, but these are some of the most pertinent financial crime risks that we see globally. And we are quite interested to understand how does the measurement, how does one self-identify, how does one get comfortable with these risks internally as a respondent bank, and how do you measure that, and how do you actually come up with a framework to have different parameters of these elements coming up and signing up together. I don't think we need to talk about money laundering, terrorism financing, human trafficking, sanctions. Well, these are topics which are relevant, which have been there for a long time. And most of the banks right now have a framework and understand these risks quite well. What might be evolving and something that is possibly horizon risks that we see, and maybe something that one should watch out for. And I think 3 areas which are more of new: virtual assets. We are increasingly seeing the risks of virtual assets. How does a framework get built out? How does an FI self-manage, self-regulate in a situation where such assets might not be recognized or might not be regulated also in certain countries and jurisdictions? Similarly, cybercrime, almost in sync with virtual assets, we are seeing them as an evolving risk. Much more teeth is developing, and because of its global scale, because of the deep impact. You must have seen the Microsoft attack yesterday, the cyber attack. This is something that is really real, extremely sophisticated, and something that needs to be understood quite well from an FI standpoint, especially simply because of the scale of its impact can be. We have seen situations where funds have been wiped off, data has been compromised, personal details have been shared. And obviously that means, as an FI, how does one scale up? How does one identify, manage, and mitigate such risks? The third one is wildlife trade. As a bank, we are quite passionate about this thing. There's a huge social impact. And especially in the corridor that we deal with, we see certain hubs, certain trading hubs actively using business trade to actually do wildlife trade. It might not always be relevant. It might not be always quite visible, but obviously the impact, the social impact, and the responsibility as FIs and as respondent banks is paramount. This is something that is we are quite passionate about. We do have an agenda globally that we must support illegal wildlife trafficking, and ensure that we have got the framework to identify, manage, and support the management of the risk of illegal wildlife trafficking. Especially, I think in the corridor that Pakistan is, we see this as a corridor where such trades do happen. It's unfortunate. We see that in a number of other corridors as well. Dubai, as an example, is known to be a hub for wildlife trade. So it might not be originating, but obviously is a conduit, obviously is a part of the whole chain of events and the chain of wildlife trade and illegal trafficking that we see. And we as FIs have a role to play, and a big role to play in that. Moving on, I would like to leave you with this slide, and which is essentially around, as to what are the pillars and how do we manage the most effective FCC program. So this is essentially what we see as the pillars of success of a successful FCC program. So whilst on the top, you've got the strategy of the bank in terms of how it wants to do business, what it wants to do business, and where it wants to do business. And underlying the banking strategy lies the risk tolerance. How much the bank can take a risk. What is the risk tolerance in geographies, products, businesses, customers, variety of other scales. So supporting those risk tolerance statements, we want to see is what are the control environments that a bank puts in. It can be CDD, sanctions, surveillance, essentially AML programs, anti-bribery and corruption. So these are the topmost pillars from a control standpoint, where the bank, as part of its wider FCC program, builds in strategies, programs, controls on these 4 pillars of control environment. Supplementing those controls are the enablers of financial crime compliance, where you have got the enablers of governance, which essentially means oversight, board oversight, governance oversight, senior management oversight and reporting, resourcing, learning, continuous education learning, information reporting, risk assessment and assurance. So these are the enablers which an FCC program should be supporting the control environment in building out a strategy of supporting the business in its wider strategy. So this is essentially a slide. This is essentially what we want to see in every program. It's not really a tick box exercise. Essentially, that how does each of these elements play out within each of the fundamental FCC programs that you have. And these are not mutually exclusive. The idea is to have a mutually inclusive environment where your controls and your enablers work in tandem and support the financial risk management strategy. The most important at the lowest part of the slide is the group's conduct. That's kind of like an understatement. It can't be an understatement, really. It's like a bold understatement which reinforces the strategy that what ultimately matters is the group's conduct, the organizational conduct. If you've got the right conduct program, the right business principles, you should be able to sustain and should be able to come up with an effective FCC program. So whilst the FCC program is a wider strategy around financial crime risk management, what really underpins, what accelerates, what really supports, and what really improves the ability to a superior scale is the conduct and the conduct strategy of organizations. That really reinforces us as correspondent banks to see that whilst there can be issues, whilst there can be problems, whilst there can be financial crime risks in every market, what's the conduct? What are the conduct principles that the organization is built on, which supports management in a much better way and supports the goals of the organization to make them successful. So this is, again, we shouldn't have a conduct program running exclusively in parallel to the FCC program. The conduct program really is a part and parcel of doing business. the conduct program really is supporting the business strategy on a day-to-day basis, 365 days a year, breathing, living the conduct on a daily basis. So I would really leave that with thoughts around that, which is around the FCC program effectiveness, supported by controls enablers, but primarily, most importantly, the conduct, which trumps everything else from a risk management point of view. Thank you. If there are any questions, I will be more than happy to take them offline, or I can take them from the organizers of the event as well. I hope you have my details on the screen or as part of the program details. I remain open to any kind of questions and happy to support you and help you with this goal going forward. Thank you so much.
Is Sumit still with us? Are we taking any questions for him? We have time enough to take one question if somebody would like to ask that.